What's up, everybody? If you came to hear trends and bold predictions from Selma and Michael and Rob, you are in the right place. I am super pumped because we have leaders not only in mortgage, but in housing. I always say it, but I'm going to say it from stage to kick this off. People don't get loans because they want loans. They get loans because they want homes. And something every time I'm on a stage that I'm pushing, the American dream is not just homeownership, it's homeownership, and it is financial freedom. So I think it's never been more important that mortgage professionals are not just doing loans. We're helping people beyond the transaction. We're helping them pick the right loan to achieve homeownership. We're helping people overcome affordability challenges. There's an affordability crisis. So we have Selma Hepp, the chief economist for CoreLogic. We have Michael Fratantoni, who's going to go first, the chief economist for MBA. And then we have the one and only, I think everyone knows him, Rob Chrisman, top newsletter in the mortgage space. Welcome, Rob.
Glad to be here, Dave.
Good.
And don't, definitely throw yourself into that mix. Everybody knows you as well.
Well, it's my party, so hopefully they know us if they're at this call. What's up, everybody? Super grateful for your time, and we'll try to really bring some insight and some confidence and clarity. Selma, this is the first time I've got to interview you and have you on a call. Thank you for joining us.
Thanks for having me, Dave.
Yeah, and Michael, you always, pour into this community, and we're super grateful for you doing that, brother. Thank you.
Oh, appreciate the invitation to be back. Thanks.
Right on. So before we start presenting and bringing content ideas from you, I mean, it would be great to push a poll question, and we'd love to know, from the community, what are the most common concerns you've heard from, customers lately? Are they talking about inflation? They're talking about higher interest rates, the cost of borrowing, anxiety, something else. Put something else in comments. Put things in comments. I'm going to give you a chance to do it. Rob, any thoughts? Like, if you were in the audience right now, I'm sure it's something else, but what do you think consumers, are most concerned about right now, Rob?
I would say I probably refer to my commentary once or twice, Dave, during the session, but today I wrote about the high cost of credit card debt. First of all, credit card debt crept north of $1 trillion in the first or second quarter of this year, which is a big number. But on top of that, I started sniffing around and looking at what companies actually charge for credit, and I was stunned. You want a Kohl's credit card or a Home Depot credit card or a Nordstrom's credit card, you're talking about 28, 29, 30% APR. And I think that is, crushing. The consumer continues to motor along, but at some point the Fed's increases will have an impact, and I'm sure Mike and Selma will talk about that. But that is a big thing that I think not only impacts consumers, but also impacts industries. But it is part of the overall debt environment. And we talk about affordability issues, which we'll talk about on this session, but talking about affordability issues with mortgage rates around 7 or 7.25%, definitely impacting the industry, but debt everywhere is expensive. And I think that is a problem that impacts everybody, whether they own a home or not.
Yeah, no, really, really, really good point. Nicole, if you could push what the audience said, in the survey, what the audience said. So, high rate of costing. So I think what you said, Rob, fits within that category. Take a screenshot of that. If anyone has not answered and you have an answer, it's not too late. We're going to look at this. We're going to create micro content from this, and it will help us deliver a better presentation. So, Selma, before I bring Michael on, because he's going to present first, how would you answer that? What do you think consumers are most concerned about? And if you want to repeat, Rob, you can, but what is your thought on that?
Yeah, I think, I'm on board with Rob. I think, everybody's concerned with cost of borrowing at this point. I think they're also worried about political situation. I don't know if, well, I am. I don't know if other folks are, but I am. I mean, we're about to encroach onto election season, and that usually, can be, that can swing consumer sentiment in all different directions. And consumers have been really sensitive in terms of, things that are going on there, volatility, uncertainty, and then, and bring it back to the housing market. They're increasingly unsure if they should be entering the housing market right now. Well, mortgage rates being one reason, cost of homeownership, just prices in general being another reason. But then also, like, is it a good time to buy? Is it, in light of everything else that's going on? So I think, where we are, and we'll talk about that in a moment, in terms of volume of transactions being so low, I think it's also a sentiment. It's also a consumer sentiment issue.
Yeah, no, really good point. So one more frame I want to put around the rest of this conversation. I don't care whether you're a head of production on this call, you're head of marketing, you're a regional leader, you're a branch manager, you're a loan officer. We need to bring the news to our local economies. And, like, we're going to share a lot of macroeconomic national content, but I want everyone to be thinking, like, okay, how am I going to take this national news? We want you to use these slides so that you can be the news in your market. But if you, like, I see a lot of loan officers news hacking and trying to be the news, and that's great. Like, keep doing that. But if you want to get leads, you need to hyper localize it, hyper personalize it for the consumer. And I'll talk about ideas how to do that, because if you just bring macroeconomic news, you'll get likes, you'll get views. But if you want to get leads, you've got to hyper personalize, hyper localize what you hear. So, Michael, I would love your answer on what you think consumers are worried about, and then, start sharing your slides and give us our first briefing.
Okay, thanks a lot, Dave. So I think the audience responses make a lot of sense. It's high rates right now. We're touching the levels of rates we hadn't seen since last fall, well above 7% now. I'm trying to think about what on earth is happening, because the economic news wouldn't support that move in rates. And in particular, so much focus on inflation. The inflation trends are headed in the right way, and inflation's coming down. We're certainly still well above the Fed's 2% target, but all of the signs pointing to this problem that got out of hand beginning to become manageable again. But what's happened in the last month? Well, it is August, Dave. You can check your calendar on the wall, but what happens every August? People go on vacation. That includes bond traders. Markets become illiquid. So any piece of market moving information has more of an impact than it would at a different point in the year. So what kinds of things have we seen? Well, the U.S. federal government was downgraded by Fitch from AAA to AA plus. With that, Fannie and Freddie downgraded. Probably not a huge impact from that, but it certainly doesn't help. At the same time, the Treasury announced that they're going to be borrowing a lot more money. Federal budget deficits are just enormous and are coming in larger than expected this year. That certainly has been pushing upward on rates. But then we do have a countervailing trend too, which is increasing signs of global economic weakness, particularly in China. But you don't have to look very far to see it in other parts of the world as well. So on the one hand, I think the fundamentals support our story of a slowing economy, and with that, rates trending down. But you do have this counter, at least in August, with less liquid markets because of some of this most recent news. The next pieces of news from the macro landscape that you should be watching for. So 2:00 today, the minutes from the Fed's last meeting are going to be out. And that'll point to what I'm showing here, that FOMC participants all saying they have successfully moved the Fed funds rate, 5.25 points up to a restrictive stance. What does restrictive mean? That the Fed funds rate is above expected inflation over the next year. That's what we're showing here in this graph. If inflation keeps dropping, Fed President Williams said last week, they can drop the Fed funds rate and still keep monetary policy restrictive, just as long as the Fed funds rate is above expected inflation for the next year. So the big thing to watch next week is Chair Powell speaking at the Fed's Jackson Hole conference. If he repeats that line that President Williams said, that they're now in a restrictive stance and that they'll be able to cut rates going forward so long as inflation keeps dropping, and it sure looks like inflation is dropping, then we should see short-term rates moving lower as we get into 2024, probably end of first quarter, early second quarter. That's what we're showing on the chart here. The rest of rates, whether 10-year treasuries, 30-year mortgages, are going to anticipate that eventual cut in Fed rates. So while we may move up our forecast for the 10-year treasury and the 30-year mortgage for the remainder of 23, sort of the qualitative nature of this forecast of expecting mortgage rates to drift down over the next couple of years, I think is solidly in line with those fundamentals I just walked through. Why could we be wrong? Well, if some of the factors that are pushing rates up today, I mentioned the increased treasury issuance, if that moves further up, that's going to put upward pressure on rates. If we're misreading this global environment, if the news out of China is just sort of a short-term slowdown as to a more significant slowdown, that could have us be premature with these rate drops as well. But those are some of the things I would highlight to watch. The other aspect that we really have been harping on over the past year is one factor that's keeping mortgage rates high is that the spread between mortgage rates and treasury rates is unbelievably wide. And we're showing here the history back just a couple of years, but we have the data point that from 2009 to 2018, that spread was 184 basis points. Thus far in 2023, we're at 293. Why? What's driving this spread to be so wide, and why could it come in? Number one, uncertainty about the Fed's monetary policy stance. As I said, I think that could be resolved as early as next week with Powell's Jackson Hole speech. Two, the direction of the Fed's balance sheet. They're allowing their MBS holdings to roll off. Investors are concerned that they could move faster. My read of the FOMC statements is they have been incredibly consistent on that. They're not going to change their pace of roll off, and they're not going to move to active sales anytime soon. Third factor that's leading the spread to be wide is concerns about sales from the failed banks. So Silicon Valley Bank, Signature had significant MBS holdings. The FDIC has sold about 80% of their MBS so far at not much of a discount. So that should be winding down. So for those three factors that we think are going to be reversing over the next 6 to 12 months, we see this spread coming in from the incredibly wide 300 basis points to a still wide 250. And that's going to help mortgage rates to drop as we're forecasting. The bank issues are certainly sort of wreaking havoc on certain parts of the market, particularly jumbo. For much of the past couple of years, jumbo rates being quoted much below conforming. They're now being quoted above conforming rates because of constraints on bank balance sheets. We think, given the environment we're in and given that new capital requirements have been proposed for banks, that's going to make this trend likely to persist. Not much of a rate term refi market, no surprise there, but I want to echo what Rob said going in. I think the growing credit card debt, auto debt, the resumption of student debt payments opens up the possibility for a cash out refi need for folks that want to consolidate debt. And that's just not something we've heard in years, but I think the combination of factors here make that a real likelihood going forward. Selma's going to talk more about the purchase market, but just to show you what our weekly apps are showing in terms of most recent data, still running about 25% behind the pace that we were last year. This is on a unit basis. On a dollar basis, it's coming closer. But we think, while the refi story, it's all about rates. On the purchase story, and Selma's going to get more into this, it's more about the lack of inventory lack of homes available for potential buyers to look at. And where you really see that is if you look at our 2 purchase app series. The orange is our weekly application survey. So that's looking across the whole market. And those transactions really dominated by existing home sales. The blue is a separate survey we do on a monthly basis from mortgage affiliates of home builders. You can see on a year-over-year basis, that's up more than 25%. Right, so the new home market absolutely on fire because that's where potential buyers can actually find properties to buy. So a very, very different kind of market that we've seen over the past couple of decades, one that's increasingly being influenced by the new home sector. A very, very positive story there. So if you know a builder, sort of hug a builder because that's the friend you want to have. Existing home side, much tougher given the lack of inventory. In terms of our volume forecast, very, very consistent with what we've shown you in the past. You're looking for a 20% plus drop in dollar volume in 23 compared to 22, almost a 30% drop in units. But looking for a rebound in 24, I would no way characterize it as robust, but we think we're going to see more inventory come onto the market, both from construction, and that was supported by the starts data out this morning. And some existing owners sort of just being willing to move on and go to a new property. So Dave, let me stop there and interested to hear what audience have to say and what Selma's going to say.
All right, guys. So that was our first briefing, and we can come back to that and talk about it. And reminder, you can put comments in chat. So we want to hear your questions, your comments. Rob, why don't you go first with either questions or, commentary from that?
Well, I had a question, Mike. So you talk about mortgage volume, and what's your latest guess? I couldn't quite see because my screen was cut off slightly. But for 2023, how many? So what is your latest estimate?
So it's a little more than 1.7 trillion in dollars and a little more than 4 million in units.
And do you have on the tip of your finger, tip of your tongue, what the number of units were in 2022?
It was about 6 million, a little more than 6 million.
So the number of units down a third.
That's exactly right. Yeah.
Okay. Yeah, Dave, I'll probably talk about this during my section, but if you think about the number of units being down a third, I think companies can use that, or the industry can use that percentage down a third in terms of their overhead, in terms of their staffing, in terms of what they can plot for this year. And I don't know if the industry, Mike, you probably know better than I would, but I don't know if the industry has kept pace with overhead being down a third or staffing being down a third. Do you have any sense of that?
Yeah, industry employment, different measures for it out there, but call it a 25% drop from peak at this point. So on its way to the third that you mentioned, that was our projection about how much was going to have to be removed to get the industry profitable again. Certainly saw profitability improve in the second quarter, but a lot of lenders still struggling to break even. So I think more cost cutting is on its way, as you're suggesting.
Okay, so we'll be ready to put that in your briefing. All of us have kind of a little brief and some data, myself included, that I want to share. So Rob, be ready to tailor that. But Selma, before I have you go, I do have another poll question because I always like to get the audience involved. And so we're going to push a poll question. What are borrowers expressing as their main concern regarding a new mortgage? So Nicole, if you could push that poll question. Answer this, guys. It's helpful. Like, we can tailor our presentation. I've got some ideas I'm going to share in a little bit, but what are borrowers expressing as their main consideration regarding a new mortgage? Rob, how would you answer that one? If you were in the audience right now, would you just be clicking one of these buttons, or would you be putting in a an answer in comments that's different than one of these two.
Well, I would probably find fault with the question. Talk about a new mortgage. Are you talking about a mortgage on potentially buying a house, a new home?
Yeah, yeah.
Or are you talking about refinancing a new mortgage? being
Let's not
refinancing?
do refi. Let's just say a new house, a new mortgage, moving up, or a new home.
Yeah, I think probably I'm gonna default to the answer I hear most often from loan officers, and that is potential borrowers who are tired of being in an apartment or renting a home and subject to the landlord's rent increases, and wanting their own place. And so, yeah, rates are high, but we don't know what the landlord is going to do next month in terms of a rent increase. And this home came up for sale in a desirable school district, and little, Sage is going to start first grade next year. So, we want to move. And so the consideration I would put forth most is just stability, and having a home rather than being subject to a landlord's whims.
I like that. I hadn't thought of that. That's a cool answer. Michael, what would you answer? And Nicole, if you could push the results of the community, Michael answers, and then Selma will come to you.
Yeah, I mean, from my perspective, I was going to answer concerns about qualification, right? Whether it's on the DTI side or other, because I think there is, at least in our data, pretty clear trend of credit criteria tightening. So I think for those 50 million US individuals between 28 and 38, the first-time home buyers we're talking about, the potential first-time home buyers, that's tough to think that the qualification process is going to get even more rigorous than it's been. But I did notice one of the attendees here also noting, concerns about the market. Is it going to be sustainable? Is the market going to turn on them right after they buy? Right. That I think you have a lot of folks still with pretty strong memories of the 08 experience, and so it's leading your potential buyers to be cautious. We don't think there's going to be any repeat of the 08, but that was such an impactful experience on folks that are of the age to become first-time home buyers now.
Well, that was a perfect layup to introduce Selma and provide a real estate briefing. And Selma, if you don't mind, answering the question how you would answer it, then share your slides whenever you're ready.
Yeah, so I would probably answer it exactly the same way as most of the folks did in terms of lowering mortgage payment, because if you look at all the other possible answers, they all lead to lowering mortgage payment, right? You choose ARM mortgage because you want to lower mortgage payment. You put a larger down payment to lower mortgage payment. And then, sorry, I forgot what the third one was, but it was also about lowering mortgage payments. So I think, buy down, mortgage rate buy down. So I think at the end, everybody's just doesn't want to pay, they don't want to be house poor. We want to maybe move, we want to buy a new home or buy a first-time home, but being house poor is not it's not appealing, it's not an appealing lifestyle. So I can start with my slides actually, because a lot of them speak to a lot of the points that have been made so far. So I'll first start with my slide on home sales activity. And again, a lot of slides are very similar to what Mike showed, because mortgage trends and home sales trends are, there's a high correlation there, even though that over the last few years, we have seen an increase in cash sales activity on one hand, and on the other hand, as Mike said, there's been more activity in terms of new home sales, which is what's also driving the total home sales activity. So the slide I'm showing you here is looks at total home sales. It includes MLS and off MLS sales, meaning cash sales or new home sales. But our forecast in essence is the same because it does still depend on mortgage rates as it does depend on inventory. But before I turn to inventory, let's just look where we are in terms of our forecast for home sales. So we are down to about 20-ish% for 2023 versus, and this is unit counts, right? Versus the previous year, and in hopes that mortgage rates that we do have in our forecast, mortgage rates going down, that would help spur some activity in 2024, right? That's next year, and 2025. Though I think inventory too will help that as well. So let me bring that to the inventory now. The two lines are existing home sales available for sale and new home sales available for sale. And thinking back of, Great Recession and what happened then, and how home prices dropped in some markets, some 40%, we were at the highest level then in terms of available homes for sale at about 4 million. If you look at the top of the yellow line, it's 4 million homes available for sale going into Great Recession. And during the sort of Great Recession, and now being at less than 1 million, and so that's 1/4 of what we were back then. And then on the other hand, which is what's definitely helping put a floor under home prices. So while we are worried about what higher mortgage rates are going to do to home prices going forward, and in our forecast we still don't have a decline, and main reason being is this lack of inventory. I mean, simply anywhere you look at it, inventory is lacking in most of the places, even though there has been some increase in new availability of new homes for sale, and why that's helped add to total home sales activity is that home builders have been able to step in and provide those mortgage rate buy downs that we were just talking about to lower mortgage payments. So in a survey that I saw, some 85% mortgage builders did provide mortgage rate buy downs. So that's certainly a different situation versus existing home market, where folks that are in their homes don't even want to give up their current mortgage rate. And then the other thing, I saw a comment from a listener about, if I do, where am I going to go? There's no inventory. I don't want that much higher mortgage payment either. So it's just, it's a standstill, right? Where is this standoff in some way? But there is variation across country. I'd say, there's quite a bit differences in how markets are performing. The map that I'm showing you here is difference in home sales activity in first sort of 5 months of this year compared to where we were in 2019. And I picked 2019 because 2020 through 2022 are really difficult years. They were sort of abnormal years in many ways. So, when you look at where home sales are declining the most or have declined, it's the markets that suffer the most from lack of inventory on one, and then lack of affordability being the other reason. So affordability is huge now in markets in Mountain West that saw large spikes in home prices during the pandemic, as people were out migrating to those regions. And then we have markets that sort of historically have lacked in, or just have not built enough to the to meet the incoming population demand. So and they're now feeling even more stuck because they're least affordable markets, and mortgage rates plays a much larger role here. The jump in mortgage rates in terms of affordability. But then on the flip side, when you look at the markets in pink, it's not hard to see that these are also markets that have more new construction happening. If you rank the markets with most new home construction activity, those are markets in Texas, those are markets in Carolinas, in Florida, in Georgia, Tennessee. So this is where really the activity is happening, and it's also a place where there's been a lot of in-migration. So the demand remains relatively more consistent in comparison to these other, say, West Coast markets, where not a lot of people coming in, and so not a lot of movement. The other thing that to keep in mind is for folks that are moving to these regions and potentially moving from areas that are higher income, they have more cash to work with, so they are willing to pay these high prices, put more down payments, or even pay with cash outright. So we looked at the incomes of mortgage applicants coming into large metropolitan areas versus applicants leaving large metropolitan areas, and the difference was some 30 to 40% in terms of income. So the people, in other words, that are coming in are much higher income folks, so they can in fact afford these high prices. Okay, so but the other thing I think this is one big concern for me is the turnover rate. This is a national number, but if you look at the markets with constrained inventory, this rate is even lower. So we're looking at a ratio of home sales activity to number of households. And we are now in 2023 at this point at the lowest level that we've been since the bottom of the Great Recession. And you know, if you sort of look at what the normal rate is, which is something of 5.8%. At the beginning of this millennium, you would have some 2 million more home sales at this point than we have if that turnover rate. So again, lock-in effect playing a huge role here and constraining the velocity in the market. The other thing I want to point out, which I'm not sure actually, now that I think about it, should have actually talked about more about availability of equity that existing homeowners have, because that's what driving the demand in some of these markets where folks are out migrating to, or look at investor purchases. On either side, they're sort of mostly cash purchases. But investor activity is still relatively high when you look at the share of total home sales purchases. So the gray line is investor share and the orange line is the actual purchases. That's the right side axis. And, you know, while it has come down from pandemic peaks, and during the pandemic, there were some 120,000 properties per month going to investors. Now it's at about 80 to 90,000, and that's up from some 60,000 going into the pandemic. So, I mean, anyway you look at it, I still believe there's quite a bit of investor activity happening in the market, and it's 1 in 3 homes. And so to what degree that's, you know, there's a huge question now to what degree that's preventing first-time home ability of first-time home buyers to come in. One other thing we're able to do is break this data by size of the investor and say, so when we say investor, you know, people immediately go to institutionals and mega investors, but it's actually small investors that have been more active in the market. That's the top orange line. They've always been more active or higher share of activity. But if you look at them all the way to the right, you can see that their share has actually gone up since mortgage rates have gone up. And I think that speaks to some of the, you know, wealth accumulated, and, you know, a lot of these smaller mom and pop REITs, small REITs that are being created. And when you look at where these folks are most active, they're active in these very inventory constrained markets because they're betting on future home price appreciation, which brings me to our forecast for home prices nationally. And I'll dig into some of the markets in a moment, but nationally, I think it's been really interesting to see the spike in home prices in early months of this year. So the green line on the left-hand side is month-over-month changes. Historically, the average gray line between 2015 and 2019, there is some seasonality, but the green line sort of outpaces that average, that historical average or normal average in some way by quite a bit, almost double in February, in March, April. And so, you know, I think in thinking about how decline in mortgage rates, I don't think the mortgage rates need to go down that much for us to again see pressure building on home prices, as you can see in these early months of this year. Now, in May, we've returned sort of a plateaued back to that level of monthly appreciation that we do see historically. But as a result of the strong appreciation early this year, we are not forecasting a decline. We had a small year-over-year decline previously in a forecast. Now we're not seeing that. In fact, we are seeing home prices. Now, again, I will caveat that with not expecting home prices to exceed 7% at this point that we've seen over the last month, but keeping them somewhere in the 6.5% appreciation, accelerating to almost over 6% by the end of this year before slowing down. Now, again, there is a variation across markets, and markets here in red, darker red, that seem so far larger declines, definitely resetting in terms of home prices to meet a more to be more in line with local incomes, versus markets in gray, green, and yellow, where either small decline or no decline at all, which has been really, really interesting. But even in the markets that we have seen a large decline since summer of last year, and that's the first column, peak to trough, in the table on the right-hand side. In current to peak, you can see that in all of this, there's already been improvements, or home price appreciation has already gone up enough for the shrinkage of the peak to trough changing home prices. So lastly, let me just look at our forecast by state, which is interesting in a sense that we have, this sort of tale of two markets. On the West Coast, Mountain West, we are still dealing with those declines that happen. So we have to, climb out of this decline. So which means for year overall, we're likely to see slight decline in home prices. But then in the green states, you're looking at, anything over 4% increase in home prices, even up to 6-7% in home prices. So yes, affordability is an issue, but markets that are more affordable are now, as a result, seeing more pressure building on their home prices. So I'm going to stop with this slide, and I'm going to stop sharing. We can take some questions. Turn it over to you, Dave. You're muted.
So everyone, we will put a link. Yeah, by the way, I just saw a heart. Let's let Selma know what we thought of that presentation. If you got value from it, give us a little reaction. So lots of hearts. That was great. And we'll put a link. Selma.
Hey, Dave, those are all from people on the East Coast who aren't watching their property values plummet, peak to trough.
Yeah, no doubt. And I see people asking for the slides. We'll make sure we tell you how you can get those. Also, Selma put a link to the page on CoreLogic's website, where, just can't recommend enough. You guys follow this. It's CoreLogic.com/intelligence. We'll help you spell that for anyone who needs a little help with that. Well, there's a whole story on a time that I misspelled the word intelligent. So Rob, I know you're going to go next. I do have some slides I want to share, so try not to use the rest of the call. But before we tee you up, Rob, Michael, is there anything you want to call out there, or anything you want to ask Selma before Rob jumps on stage and presents?
Maybe just real quick. So, Selma, our home price forecast is similar to yours, looking for a small increase this year and next. But I talked about this, the really stark differences between the new home market and the existing home market, and we are seeing pace of construction increase. So, as builders are able to put more units on the market, how are you thinking about how that impacts that home price path?
Right. I think, obviously more inventory would slow home price appreciation, right? And we do at this point. I think we can't emphasize enough the lack of affordability. So that would help home prices. I do think that the stark difference in where these homes are being built will impact. And one thing that sort of didn't come across in my forecast map of by state is California, for example. And Rob, I don't know where you are. I'm also in California. Dave is in California, worried about our home prices, but our home price forecast for metros in California is among the strongest. Not, as a state, it sort of averages out, and it sort of, you have to make up for some of that loss. But in terms of acceleration in appreciation over the next year, we're sort of seeing home prices rebound back to where, to get all that loss that we've had because of lack of inventory and no new construction. So I think, again, it will depend on the market where, so maybe some of these really strong areas in green will not see, say 7%, though, if you think about Missouri, 7%, Missouri is a very affordable market. So one can sort of see. The other thing, what I'm noticing too is, where new jobs are going, right? Where people are moving. The other thing is, some of these areas are expected to see a lot of new employment growth from EV plants and things like that. So new technologies driving demand in some of these newer markets that we traditionally don't necessarily talk about. We always talk about East Coast, West Coast, but there's a lot in the middle too.
Love it. Mr. Chrisman, you have some prepared thoughts?
Well, Dave, when I first saw the title of our session today about bold predictions, I was immediately set to work putting together a presentation based on UFO data and the fact that more ancient civilizations would be discovered. But then I thought, okay, we're going to focus on housing and interest rates and so forth. So I know we've covered a lot of historical data here. I'll get the laughter there, but we talk about historical data, and Mike's looking at charts and the graphs, as is Selma, some very, very informative charts and graphs there. I wanted to swing it back towards the practical application of what people can do with this information, what CEOs, managers, and owners are doing with this information and how they are viewing the current environment. Because to be frank, the current environment's a tough environment. It's a rough environment. I don't think anybody would want to see that sugar-coated. And I think the point that I would want to make is, and Dave, you've heard me mention this before, even if interest rates were zero, right? Dave, you come to me, I'm a loan officer, and Dave, you say, I want to put my family in a 3-bedroom, 2-bath house in the suburbs. And I say, that's great, Dave. Based on your credit profile, I can offer you a 0% interest rate for 30 years. And you're like, great, that's great, Rob. I knew there was a reason why I came to you for a loan. And then you go out and try to find a home. And if there's no inventory, it doesn't matter that I have 0% financing for you. If you can't find a home, you can't find a home. If the baby boomers aren't moving because they're going to live forever in their 3-bedroom, 2-bath house in the suburbs, and they don't want to sell because they'll never move into an assisted care facility, there's no inventory. And frankly, the amount of inventory, or I should say the amount of raw land that can contribute to inventory that's within, a half an hour or an hour of a major metropolitan area, is very, very limited. And so you have builders out there or contractors or an effort to try to convert, say, existing retail space, malls, into housing, or office buildings into housing, which is very, very difficult. So much easier said than done because of just the way offices are built and the plumbing and electricity and so on. So it's a real problem because, to Selma's point and Mike's point, it doesn't seem like a lot of people want to move. And it doesn't seem like at this point a lot of people really want to refinance if they don't have to. But of course, we all know about, I think, Mike, you have the figures at your fingertips, but I think, 20 to 30%, maybe a quarter of the applications that are coming through these days are for refinances because people need that money. they have to pay for a wedding. Maybe they want to pay for an RV. Maybe they want to pay off their 30% Nordstrom's credit card debt, whatever it is. There's a certain amount of refinancing going on. But what I'm seeing owners and CEOs do is say, okay, here's the rate environment. The rate environment is the rate environment. We have to deal with it, but we can't change it. Okay, inventory is what inventory is. It may loosen up at some point as baby boomers actually do move. But Dave, to be harsh and blunt in terms of bold predictions, I think that a lot of companies out there are fighting to stay afloat, to stay alive. And they are taking the rate environment, they're taking the inventory environment, and they're saying, what kind of programs can we offer our borrowers? Because every borrower that comes through the door is a precious commodity at this point. So how can we take the interest rate environment, the housing environment that Mike and Selma have talked about, and figure out how best to help our clients? And how can we stay alive to do that? How can we stay afloat? What kind of cuts do we have to make? Do we still need loan officer assistance? Do we still need this underwriting team? Do we still need this? How can we make things more efficient? How can we automate things? Because at some point, the market will come back some, rates will drop some, mortgage activity will pick up some, and companies want to be ready for that. So they're cutting costs now. My bold prediction, which maybe isn't so bold for a lot of people in the industry, is that we're going to continue to see cost cutting heading into the autumn and winter, because I'll tell you, autumn and winter have never been boom times for mortgage banking, except for 2020, 2021. So you have companies out there trying to stay afloat. You have, my prediction is we'll continue to see packages of servicing being sold, because that is the lifeblood of a lot of lenders who have retained servicing. So they're going to be selling servicing. And then lastly, I think we'll continue to see mergers and acquisitions, not only with vendors, but also with lenders who, you have two lenders who decide they don't need two capital markets departments and two underwriting departments and two quality control departments. They can merge and only have one of each of those and try to be efficient and try to, play for the long game. So I still see some pain ahead. And we started off the call talking about, staffing versus cuts in units, or the decline in units that the MBA is expecting to see, which I agree with fully. I see more of that. So it's not very rosy or nice, but that's kind of my prediction, is that we're still dealing with an industry with some overcapacity, and companies are going to have to be dealing with that.
Yeah, no, really, really good thoughts. And, kind of brings to the point that the industry is currently, from a headcount, down 25%, volumes down 33%. I want everyone to ask yourself a question. If you were 10 basis points more profitable right now, what would that mean to your organization? And here's the deal. I know this because I sell TrustEngine to a lot of C-suites. I have yet to go into a C-suite where if their loan officers were better trained beyond the transaction and delivering more value, they could be 10 basis points more profitable. They could be 20 basis points more profitable. I'm going to share a few slides and then let's do some Q&A. But, Rob and I, sounds like I didn't realize it, we got in the business at the exact same time. I don't know if same month, but in 86. And I don't know about you, Rob, but when I got in the business, rates had come down, and a lot of the loan officers had bought houses. They were buying nice cars. They killed it. And I came in as a loan officer. You came in as a, secondary guy, but rates, they went sideways for about 5 years. And then here's the deal, guys. Rates have gone down my entire career and everybody's career. I don't care if you've been in the business for 3 years, 4 years, rates have gone down. They bottomed out and now they're here. And a slide that didn't come up in the briefing, but I think it's a really important slide for lenders to think about as we prepare our sales force to get leaner, and to be more efficient. Is, this slide didn't come up, but guys, this is how many people have a rate of 2%. This is how many folks have a rate of 3%. Homeowners, This is how many homeowners have a rate of 4%, and guys, rates are up here. So guys, that's a problem. Like, it's not like all of a sudden these people at 2 and 3 are going to want to start selling. So, and then I just saw this graph yesterday, and I knew this, 42% of Americans own their homes free and clear. And everybody who owns a home has a lot of equity. So that's opportunity. So I really have never been more evangelical that loan officers need to become advisors. This was an article from, I don't know if it was Fortune or Forbes, but I love these terms: household hostage and accidental landlords. The America is full of them. And real estate agents have never dealt with this. And by the way, a lot of real estate agents don't even know this data. So remember, hyper-personalize, hyper-localize this content. And so loan officers need to become great at helping a household hostage make an informed decision. And by the way, it's not going to be because of the transaction or interest rates. If they do move or they become an accidental landlord, it's because they start to see, what? There's net worth to be gained by moving up. There's financial freedom to be gained from investing in real estate. I don't know if everyone knows it, but the 40-year average is 7%. And you can see we've, most of us since 2003, we've enjoyed a sub 7% market. And now we're getting back to normal. And so my message to every head of production, CEO, marketing managers, we need to train our sales force to operate in a market that's reality-based, that, even though, Michael, you still think rates could get 4.5? Is that still on the horizon?
Yeah, sort of by 25, no longer in 24.
Yeah. So, but this is how we need to operate. Like, we need to have the right size organizations, and we need to train our sales force to operate under these conditions. And we've hit $1 trillion. Like, this is dated. I got to get a new chart. We've hit $1 trillion in consumer debt, and it's going up, and it's expensive. Equities going up. And it's, by the way, it's an opportunity for families to build wealth faster. It's an opportunity for families who have equity and wealth to help their kids, to help their family get into home ownership. And guys, like, this is crazy, Michael. I looked at this slide and saw the delta between refis and purchase. Like, this has never happened before. That's why we're in this pain game. And then now here is a shining light. But there's a little wave. Well, it's not a little wave, it's a big wave of first-time home buyers, millennials hitting that prime time age. And Rob, the way you opened it up, there's a lot of folks that are like, they want to own their future. They want to own a home. They don't want, they want to have the dog that they want. They want to make the improvements of the home they want. So, this is a concept I want to, share, and then we'll see how much time we have for Q&A. But speed to lead is no longer good enough. My entire career in mortgage, if you were the first one on the call, you won. What we believe here at TrustEngine is that we've moved into an era of speed to need. You still need to be the first one on the phone call, but you need to get to the need of the consumer, and then you need to solve it. That household hostage, that first-time home buyer. We think there needs to be an advice revolution. It's one of the reasons why I'm doing the Mortgage Coach 10X training this entire month and next month, is to help, like, your sales force needs to learn how to give advice and to give clarity to consumers in a very personalized way, not close loans. Closing loans is still important, but that's table stakes. So, Rob, anything you want to say to that? Let's, give a round of comments to that, and then we'll kind of go into some closing thoughts.
I think, Dave, you did a very good job there. You have to look at things constructively, and it's very, very difficult. And Dave, that's not my little heart rising up to the screen.
I know it was your heart. Come on,
Although I do have
a
big crush on you. But I think the way you look at it is very constructive. And as I mentioned earlier, it's here's the situation. How can we make the most of it? As a loan officer, how can I make the most of it? How can I get the leads? How can I, the borrower comes to me, they may not be a client immediately, but I need to be in a position to give them advice and consultation and information that, when they do come back to possibly buy a house, they think of me. And I think that's what I'm seeing loan officers do out there is, once again, looking at the long game, trying to think about things in the future, because right now, yeah, rates are high. Right now, there's no inventory. Those things will change. We're in a cyclical business, but the potential borrower's impression of you is very important to establish now for future business.
Yeah, thank you for that. Selma, I've got some closing thoughts, but Michael, closing thoughts, and then Selma, and then I'll close it out.
Yeah, Dave, I think you set it up right, that it's going to be a market where it's really not very likely that we're going to get a big refi boom in the next couple of years. In some ways, that makes the business more predictable, right? The purchase business has always been more predictable. That demographic chart you showed is the driver of a lot of first-time home buyer behavior. And now what we're waiting for and beginning to see is some additional inventory hitting the market. So I know our characterization the next couple of years, purchase market, slow upward climb. And I think to the points Rob has been making on this call, I think getting the industry right sized to the opportunity the next couple of years is the right way to think about it.
Selma, thoughts?
Yeah, of course, I echo everything you guys said so far too. I would say one thing maybe that is positive, or to keep in mind, is we're sitting sort of at the bottom right now, and only where we can go from here is up in some ways. So that's giving me some hope too, because and then the other thing is, as we're sitting here on a bottom, we are not the housing market and the economy is not as damaged as it was coming out of the Great Recession, so it's going to be, once when we propel, it's going to be faster. I feel like, or at least there is, between the demographic cohort and greater incomes that this demographic cohort has, and not the economy that's not scanted, I think the outcome is going to be better. So I have optimism. I think we just have to remember we're at the bottom right now.
Yeah, or very close to it. Well, I've got lots of optimism, and I want to be as constructive and useful as possible. But when you look at all this data, your loan officers need to start getting into the advice revolution. I mean, one of the reasons why I'm doing a training every week is I believe that every loan officer could get an extra loan right now, an extra loan a month, if they just did the right actions. I believe, and by the way, I believe that everything I'm going to say, they could do it in a way that's sustainable over time. They could get one extra realtor this month, and they could do it in a way that they could do it every month. They could reduce their price exceptions. And by the way, I know that, I've got data on that, but delivering a fee worksheet at the point of sale, guys, this is what a fee worksheet looked like, when an LOS came out in 1989. Like, loan officers stop. You just, you got to be compliant, but you don't need to deliver a fee worksheet to be compliant. You can give options. And in a market like this, and I know this firsthand because we have data and results, that loan officers that don't give this, but they give this at the point of sale, they show the consumer, hey, here's a super low rate with high points, 2 points, 1 point, no points. And then, hey, rates are going to be in the 5s at some point. You gotta help a consumer make an informed decision. A lot of people in the mortgage industry call that, date the rate, marry the house. But every loan officer in America needs to know how to have this conversation if you want to optimize. And here's the deal. Every loan officer that's delivering a fee worksheet is costing you an extra 10 basis points, extra 20 basis points. I've got case studies to prove that. So hopefully we'll put a link where you can get a demo of TrustEngine, but we're on a mission to change how loan officers show up at the point of sale. They need to be more valuable. They need to be more consultative. They need to help borrowers make better decisions. You need to make sure that your database actually is predictive. CoreLogic does a great job of providing data services. TrustEngine, that's what we do, is we take that data And then we help turn it into advice. Like we automate, who needs a loan, who needs a purchase, who needs a refi, and make that more predictable. This is just one case study, guys. NFM Lending has like 400 loan officers. The 93 loan officers that use Mortgage Coach at NFM are 65 basis points more profitable, and they have a 10% better conversion. So every lender, that would be the other message. Every lender right now, you could improve your profitability by training your loan officers to give advice and value, not price. This is just one example. So I'm going to put a link down below to sign up for ours. Rob, I think everybody in the mortgage and real estate business subscribes to your newsletter, but if anybody on this call doesn't, where would they go to sign up for Chrisman?
Just www.robchrisman.com, www.robchrisman.com. And Dave, I've got to jump. So,
yeah, no problem. His son has an awesome podcast. Make sure you check out Robbie Chrisman's podcast. Mr. MBA, Michael Fratantoni, what is the best? We still got Michael. What is the best place? I know we can go to, your website, but to get your current economic data, what's the best link for folks to go to?
I'd recommend two things. You can sign up to get our forecast as soon as it's available. So just go to mba.org and go under forecast. You can sign up there. And then every Friday we put out a chart of the week. So our view on the most interesting data point that we want to highlight in that given week, and free to everyone. So please sign up for both of those.
We'll put links down below. If you're watching this in one of our YouTube channels, there'll be links. And Selma, I know you gave us one link in chat a while ago. We'll put that in the YouTube channel. If you're watching this in YouTube, Selma's link. Is there any place else? What's the best social media place to watch you and follow your content? Where are you most active?
Yeah, I'm most active on LinkedIn. I'm sort of not a believer in Twitter anymore. I believe in LinkedIn.
Okay, great. So we'll follow you. Thank you both, everyone who tuned into this and gave us your time and attention. We're grateful. And this is a wrap. TrustEngine YouTube, Mortgage Coach YouTube will air the video. Take care, everybody.